In the world of cryptocurrency, fortunes are made and lost overnight. But what drives these wild fluctuations? Is it the whims of the market, the fear and greed of investors, or the invisible hand of unseen forces? These questions may seem daunting, but fear not. Today we dive deep into the cryptocurrency rollercoaster, uncovering the secrets behind its volatility and how savvy investors navigate this treacherous market. So buckle up, it's going to be a thrilling ride. To understand the rollercoaster ride of cryptocurrency, we first need to grasp what volatility is. Volatility, in simple terms, is the rate at which the price of an asset increases or decreases for a set of returns. Cryptocurrencies are notoriously volatile compared to traditional fiat currencies. This means the price of a cryptocurrency can change rapidly in a very short time, making it possible for investors to experience significant gains or losses. Now, why is volatility so pronounced in the cryptocurrency market? Unlike traditional markets, cryptocurrencies operate 24/7, meaning trading never ceases. This constant trading can lead to a flash crash, where the value of a cryptocurrency dramatically falls only to bounce back up again within a matter of minutes. Another key factor is market sentiment. Cryptocurrencies are largely driven by investor emotion rather than intrinsic value. Fear, uncertainty, and doubt can create selling pressure, while greed can create buying pressure, pushing prices up rapidly. Next, regulatory news plays a huge role. Being a relatively new market, any news regarding regulation can induce significant price swings. For instance, if a government announces a ban on cryptocurrencies, it could lead to a price drop. Conversely, positive regulatory news can cause prices to skyrocket. Technological advancements also influence volatility. Cryptocurrencies are based on blockchain technology. Any major breakthrough or setback in this technology can result in substantial price changes. Lastly, we can't forget about whale movements. In the crypto world, a whale is an individual or organization that holds a large amount of a particular cryptocurrency. If these whales decide to buy or sell, their actions can significantly impact the market due to the sheer volume of their transactions. As you can see, market sentiment, regulatory news, technological advancements, and whale movements are just a few factors that can send cryptocurrencies soaring or plummeting. Unmasking the volatility of cryptocurrencies helps us better understand the ride, whether it's heading to the moon or plunging into the abyss. History can offer valuable insights. Let's consider some notable rises and falls in cryptocurrency. If we take a trip down memory lane, we'll find ourselves in the year 2017. It was a time when the world was just beginning to take notice of Bitcoin. Suddenly, seemingly out of nowhere, Bitcoin's value skyrocketed, reaching an all-time high of nearly $20,000 in December. It was a gold rush, a fervor, a fever that gripped the world. It seemed like everyone wanted a piece of the Bitcoin pie. Then, as the clock struck midnight on New Year's Eve, ringing in the year 2018, the tide turned. Bitcoin's value began to plummet, and by February, it had lost over half its value. The bubble had burst, leaving many investors nursing significant losses. But what caused these dramatic events? According to financial analysts and crypto experts, several factors were at play. The surge in 2017 was largely fueled by speculation. Bitcoin was new, exciting, and everyone wanted in. The media hype only added fuel to the fire, driving prices sky high. Then came the crash. The speculation that had driven Bitcoin's value up was unsustainable. As reality set in, fear took over. Investors began selling off their holdings, leading to a rapid and steep decline in Bitcoin's value. Another contributing factor was regulatory news. In 2017, several countries began cracking down on cryptocurrencies, imposing strict regulations. This created uncertainty and panic in the market, further driving down prices. Lastly, technological advancements played a role. In 2017, there were improvements in blockchain technology and increased acceptance of Bitcoin as a payment method. However, by 2018, the technology was still in its infancy and had yet to prove its long-term viability. These historical events serve as stark reminders of the potential for both incredible gains and devastating losses in the world of cryptocurrency. Knowing the risks, how can an investor navigate this stormy market? The answer lies in a three-pronged approach: managing investment risk, conducting thorough research, and maintaining a rational mindset in the midst of market hysteria. First, let's talk about managing investment risk. To put it simply, don't put all your eggs in one basket. Diversification is a cornerstone of a sound investment strategy, and it's especially important in the volatile world of cryptocurrencies. By spreading your investments across a variety of cryptocurrencies, you can potentially mitigate the impact of a single coin's plunge. But diversification isn't just about the number of cryptocurrencies in your portfolio. It's also about the types of cryptocurrencies. Consider including a mix of established coins like Bitcoin and Ethereum, and newer, more speculative coins. In addition to diversification, setting stop-loss orders is another essential tool for managing risk. A stop-loss order is a predetermined instruction to sell a cryptocurrency when it reaches a certain price. This can help limit your losses if the market takes a sudden downturn. Now, on to the second approach, conducting thorough research. The cryptocurrency market is a complex beast, influenced by a myriad of factors from regulatory news to technological advancements. It's crucial to stay informed about these factors and how they might impact the cryptocurrencies in your portfolio. This means doing your homework before investing in a new cryptocurrency. Understand its purpose, scrutinize its white paper, and evaluate its team. And once you've invested, keep a close eye on news and developments that could affect its value. Finally, let's talk about maintaining a rational mindset. The cryptocurrency market is notorious for its bouts of hysteria. Prices can skyrocket on a wave of euphoria, only to crash when panic sets in. It's easy to get swept up in the excitement or the fear. But remember, emotional decisions are rarely good decisions. It's important to stay calm and rational, even when everyone around you seems to be losing their heads. This means sticking to your investment strategy, even if it means missing out on a potential windfall. It means not panicking and selling at a loss when the market takes a nosedive. And it means not investing more than you can afford to lose, because despite all the potential for profit, there's also the potential for significant loss. By implementing these strategies, you can increase your chances of surviving and even thriving in this volatile market. And remember, while the journey may be a roller coaster, with the right approach, you can turn the ride into an adventure rather than a nightmare. Having explored the past and present of cryptocurrency volatility, what might the future hold? The answer to this question is as exciting as it is uncertain. However, as we've learned throughout our journey, a few key factors can help shape our perspective. First, let's revisit the key points we've discussed so far. Cryptocurrency's volatility is driven by factors such as market sentiment, regulatory news, technological advancements, and whale movements. We've seen this play out in dramatic rises and falls, such as Bitcoin's surge in 2017 and the subsequent crash in 2018. Yet, despite these wild fluctuations, savvy investors have found ways to navigate this treacherous market through risk management, thorough research, and keeping a level head amid market hysteria. Looking forward, the future of cryptocurrencies seems to be a tale of two contrasting perspectives. On one hand, the optimists envision a world where cryptocurrencies become mainstream. They see a future where cryptocurrencies are not only a viable investment option, but also a reliable medium of exchange, offering a decentralized and more inclusive financial system. Advancements in blockchain technology and increased acceptance of digital assets by businesses and governments worldwide support this optimistic view. On the other hand, the cautious observers point out the very volatility we've explored as a potential stumbling block. They caution that without effective regulation and widespread understanding of the technology, the risk of significant losses remains high. Furthermore, they warn of the potential for market manipulation and the susceptibility of cryptocurrencies to technological vulnerabilities. The truth likely lies somewhere in the middle. As the technology matures and regulatory frameworks evolve, we may see some of the volatility subside. However, as with any investment, risk will always be a factor. The key to navigating the future will be the same as it is today: understanding the market dynamics, managing risk effectively, and staying informed. In conclusion, the future of cryptocurrency remains an exciting frontier. Its potential to reshape our financial systems is immense, yet so are the challenges it faces. As we continue to ride this roller coaster, we should remember that the thrill of the ride comes not from the ups and downs, but from the learning and growth we experience along the way. As we look to the future, one thing is certain: the world of cryptocurrency will continue to be a thrilling ride. Share your thoughts in the comments below and subscribe for more financial insights.